Hey guys, today we're going to be talking about the balance sheet equation, commonly referred to as the accounting equation. Now, this is an easy enough topic to grasp once you understand its premise and how it serves as a cornerstone to your future thought process and approach to accounting problems. Now, say we have the financial statements of a company being prepared. Financial statements are regularly prepared and they're usually done for disclosing solid financials that back up a company's performance or reputation. They also reflect the current state of affairs to anybody who's interested to see how the company is doing. One of those statements is known as a balance sheet. What is really useful about a balance sheet is you get to see what is tangibly present in the firm through the balance sheet. What I mean by that is that a balance sheet reflects the financial position a firm is in through its current holdings of assets, current liabilities or obligations that it has to pay out to other organizations, and current equity that provides value to owners and stakeholders. The other important thing to remember about the balance sheet is that it is a snapshot of a current period in time, and it really only reflects things up until a certain date. So things beyond that date may be different and subject to change. So always pay attention to dates mentioned in accounting problems, and especially pay attention to dates when reading financial statements, because it can really affect how you interpret what is going on currently or what was present a few months ago. So, going back to the equation, it's relatively simple and it's composed of three related components. And we've already mentioned them earlier. So what we'll do is we'll go through those components individually and explain how you can use a few of the values to obtain the other. Now, the term balance sheet equation kind of comes from the premise that if you look at the financial statements of any company, you're going to see the actual components of the balance sheet equation on the balance sheet. So the three components I'm talking about are assets, liabilities, and owner's equity. And the equation itself, and this is a hallmark principle for all future accounting work, meaning you're going to see this over and over again, is assets is equal to liabilities plus owner's equity. And as you can see, it only has three components present within it. And those three components are also present on the balance sheet in the same form. So looking at a balance sheet here from a sample company, we can see that there's a section for assets that contains all of the company's assets, current and non-current, which we'll get into during a separate video. So if you don't know what those are exactly, or the differentiation, not to worry. It also contains the company's liabilities or obligations, and there's also the company's shareholders / owner's equity. So assets, as we know, are something tangible that have economic value on the balance sheet and for the firm. So some examples we'll see quite often in this course are cash, investments, accounts receivable, supplies, buildings, equipment, and vehicles. Liabilities indicate the obligations a firm has to its short-term and long-term lenders, creditors, and suppliers. Short-term liabilities are obligations that are expected to be fulfilled within a year, whereas long-term liabilities have longer payback periods. Now, these obligations can arise from actually borrowing money, or for services performed that haven't yet been paid for, or for raw materials or supplies that you still have to pay for. Owner's equity is the portion of this equation that's calculated by adding up the amount of a few items called share capital, retained earnings, common stock, and stuff like that. Let's look at this sample balance sheet. And if you look here, you'll find that we have shareholders' equity with common stock, retained earnings, less treasury stock, which is seldom discussed in this course, but may be used occasionally during owner's equity calculations. Now, note carefully though, that the total dollar amount that is given to assets is also the exact same amount that occurs when you add up liabilities and owner's equity. So add up liabilities and owner's equity and you'll see that it equals the exact asset amount. And that's it. That sums it up essentially. It's important to remember that irrespective of wherever you go in your accounting career, and I'm sure you'll see a countless number of financial statements, you will undoubtedly see this hallmark rule again and again and again. Because it never really changes, and once you really get a grasp of what composes it and your definitions of what is listed on the balance sheet are on point, there really is no reason why you won't be successful in all related questions to this topic on your exams. So, commonly on ADMS 2500 exams, the totals for each of the three components are based on accounting activity and changes that occur throughout the year. So you might be asked to reflect the new balances of assets, liabilities, and owner's equity based on changes that occurred throughout the year. Some of the examples of change are depreciation, there's adjustment entries, and the fulfillment of obligations along with disbursements related to share issuance in owner's equity. So these are the kinds of examples which can really shake up how things balance out and how things are reflected in the balance sheet. But all in all, proficiency is positively correlated to practice. So I highly recommend you take your time and you get to know what you're bound to see often on a balance sheet and what you see as changes or modifications to the components of a balance sheet. And that'll set you up to really understand what's going on when it comes to a certain accounting case, or that, when there are questions asked on an exam that relate to changes occurring throughout the accounting period.